Did the markets get a little bit more sober by the end of the week? They seemed a little euphoric after Tuesday.
Yeah, David, I think that's exactly what we saw. The Fed has had a hard time convincing the markets that there's a lot more work to be done to bring down inflation. And they need to understand, the market needs to understand that if rates are going to go higher and they're likely to stay higher through the year. We're almost there in terms of the market's forecast. They do still expect one rate cut at the end of the year. But, that is quite a different position to be in relative to the beginning of last year, where we saw many rate hikes. So there's certainly less of a headwind this year from further rate hikes, but we're also not likely to get that break that the market is hoping for anytime this year.
Well, Kristina, what about it? Is the market slowly giving up on that break later in the year? We had been told the market's saying we're going to have a cut by the end of the year. It looks like they're not so sure of that anymore.
Well, hopefully they get accustomed to that idea, because I don't think we're going to see a cut by the end of this year. The economy is in better shape than I think most anticipated, so there really isn't a reason for the Fed to cut rates later this year. Something would have to go very wrong for the Fed to need to cut rates by the end of the year. It looks like it's going to be a softish landing.
So JoAnne, what about the economy looking stronger? Can we talk about the economy? Because you talk about different parts of the economy, you get different results. I mean, look at housing. It doesn't look that strong at all. And some people this week were talking about a so-called rolling recession. I know that's something you take issue with.
Well, yeah, we're certainly seeing some parts of the economy in contraction. Housing, as you pointed out, certain parts of the technology sector where we've heard about lots of layoffs, shrinking PC production, significantly down year over year. So there's certainly parts of the economy that are suffering contraction, but there are also parts of the economy that continue to expand. And when you look at the aggregate of what consumers have to work with in terms of spending power, we have seen real disposable income rise for the last 6 months. So consumers still have more to work with, and I think that's why we're continuing to see relatively robust numbers in terms of spending.
Yeah, JoAnne, this is an important point you made to me. I want to make sure we unpack it, which is we have a tendency to take a look at wages, and we say real wages have not gone up, they've even gone down, and that's for individuals. But if you look at the additional people coming to the workforce, you can have the aggregate actually going up, which says something strong about the economy.
Yeah, that's exactly right. And in fact, if you look more granularly at the data, in fact, over the last few months, we're seeing an increase in real wages as well. So you combine that with more people in the workforce, that gives a lot of support for consumer spending. Now, it doesn't mean that a recession may not be coming at some point in the future. High interest rates are clearly an impediment to economic activity, whether it's firms investing or households borrowing for the next car or to buy the next house. So we're by no means sanguine that the recession threat is over. But we do see continued strength, for now, at least from the consumer side.
Well, consumers, as you know, Kristina, is what it's all about. What is it, something like 70% of the economy, something like that, is consumer. So what is the state of the consumer as far as you can tell?
Well, I think the consumer is in fairly good shape. What we see, of course, is an incredibly tight labor market. That's a problem perhaps for the Fed in terms of its concerns about inflation, but it's a wonderful thing to have when you have rates going up, right? You have so many people employed. Yes, they've come under some pressure in different areas because of the rate hikes, but in general, people can still afford to go out and shop. And so it's a very different environment than what we saw when the Fed was hiking rates and unemployment was higher. I mean, this is a very, very appealing labor market that leads to a fundamentally sound consumer in general.
Fundamentally sound. Let's go back on that, Kristina, if we could just for a moment, because going into this, there was a lot of so-called dry powder in households. They had a lot of savings they could spend down. They're spending that down. We're starting to see credit card balances go up. At the same time, rates are going up. At what point does that put some constraints on the consumer?
Well, it's certainly going to put constraints on the consumer, but we have to look in the context of pre-pandemic conditions. Savings are still higher than they were pre-pandemic, but they may have gotten low enough that they have encouraged greater labor force participation, right? So we've certainly seen some positive news there. And so in general, what I think is that this is an environment in which there are many consumers that have the ability to spend. Certainly, inflation has been something of a headwind, but it hasn't certainly been cured yet. But the outlook on inflation has improved. Certainly, the Michigan flash Inflation expectations today, the 5-year ahead remains at 2.9%. So they're very well anchored. I think the consumer's feeling good. Sentiment has gone up, and they're out spending. Many feel very secure in their jobs, especially lower income Americans.
JoAnne, so much of this depends obviously on what the Fed thinks, not what we think, what the Fed thinks. So what do you think the Fed is looking at? What will it look at as it decides whether to keep moving up and how far to keep moving up and how long to hold it up there?
Well, David, the Fed's made it pretty clear that they're really focused on a persistent source of inflation, which could be coming through wages. And so nominal wages are still rising. They look also at the ECI, the Employment Cost Compensation Index, which gives you a much more accurate view of what's really going on in terms of compensation. So they're concerned that that's continuing to rise at a decent clip and that could feed into inflation. They're seeing inflation still in their super core measure, that is services excluding housing. And so they're going to watch that really carefully. And that's why when they say they're data dependent, that's really what it means. If they see that start to slow down, then I think everybody can breathe a bit of a sigh of relief. But right now, we're still seeing a lot of demand for services that are keeping that inflation pretty robust. At the same time, we're seeing more labor flow into the services sector. So if you think to the fundamentals of inflation, it was all about shortages of supply. Now we're starting to see supply rolling back through into services. That could help the Fed solve this problem, but that's what they're going to be watching.
Kristina, there's a lot of talk about plateauing or holding at some point. Maybe not quite yet, but after maybe a couple more rate hikes. What if that's not enough? I mean, we know there's long and variable lags from monetary policy. What if, in fact, inflation does not come in? How dangerous it is if the Fed levels off and then resumes hiking because inflation comes back?
Well, that's the concern, right? That's the ghost of Paul Volcker, is that if you don't extinguish every ember of inflation, it could come back and fan the flames of higher inflation. However, I think we can take a page from the Bank of Canada's playbook. They announced recently that they would have a conditional pause. So they're going to be very, very data dependent, watching the economic data and inflation data like hawks. And I think that could be a model for the Fed. That means that if anything is concerning, they can move right back into action, and markets know that is hanging over them.
Well, that's interesting. What do you think of that, JoAnne? Would that take care of the problem for the market so they wouldn't react too adversely if they had to hike some more?
Oh, I think the market still would really like to see the Fed cut. If they signal, if they say, okay, we're done for now, and they'll always say they're data dependent, I think the market might grow a little bit too enthusiastic. And then if the Fed does turn around some months later and say, oh, sorry, we still have to raise rates some more, there'll be one of these resets again. So I think we're in for a year of volatility, both because of what the Fed is doing and the larger risks that the world economy is still in the middle of, whether it's the war, energy, price and supply dynamics. I just think it's a tough year heading through this because of this ongoing recession risk and the unknowns about rate increases.